or we're going to do it again. Okay, so I can refresh the memory. So I'm using Apple. Okay, so go up to stockcharts.com, put in AAPL as the ticker, and you should get this chart right here. Okay, we're going to have to update it because that's not the chart we're going to use. So once you get the chart up, you got to modify it, okay? Because you got to go back, and I would go down here. First thing you're going to do is go down here to range, right here. Click on that, and go to 3 years. And click on that, and go update right there. Okay. So now you got basically 3 years of data. Okay, going back 3 years, because that's the trading period that we're going to be trading the stocks on. Okay, then you want to make sure that you have the RSI up here and the MACD down here. Okay, then right here it's going to say when it says overlays, you got the first one should be 30-day moving average. The next one is the 50-day moving average. Then you're going to go down to this drop, click on simple moving average right there. Actually, I need to reset these. This should be 10. This would be 30. And this would be 50. And then click on update. So now, basically what I have is the 10, 30, and 50-day moving averages on these things. And I can quickly do some technical analysis on here. Support, resistance, breakout. Looks like there's a support there. Breakout, support, resistance. Looks like that turned into a support right there. There's the resistance, there's the new support. Looks like it broke out right there. I'm not going to do that. That looks like the peak. Resistance broke out to the downside here. Looks like it broke through the historical support here. Broke through that one. And it looks like it's getting close to moving it up to its all-time high. Just quick and dirty analysis. Then as I can see, what we're looking for here is the 50-day, which is in green. The 50 days in green, the 30 days in red, and the 10-day is in blue. So you technical analysts are going to have to look down here and say, okay, 50 is in green. It looks like the 10-day moved over. So there's your alert right there. And then it looks like the 30-day crossed the 50-day right there. There's your buy signal. And you're going to have to put the price in. And then it looks like the 10 and the 30-day continued. The 10-day, there's your sell alert right there. And then it looks like the 30-day crossed the 50-day right there. There's your sell, and then it looks like the 10-day. There's your buy alert. There's your buy signal. And you're off to the races all the way up to here. Here's your 50-day. Looks like the 10-day moved over there. There's your alert, and then you sold right there. And then it looks like you bought it back right here. Buy. 10-day crossed the 50-day, and then the 30-day crossed over sell, buy, held. Looks like you sold it there, you bought it there, you might have sold it there. It's a lot of trading activity right there, but you're not losing any money because trades are cheap, right? So it's just friction, right? And then you bought right here, it looks like the 10-day, there's your alert. On the 30-day, there's your buy. You might have sold, bought, held. Looks like you sold there. It looks like you were, as you can see, the 10 and the 30. Here's the 30, here's the 10. Stocks are careening, but you don't care. You sold up there. And then down here, it looks like the 10 crossed the 50, then the 30 crossed, there's your buy. And then what I would do as your last trade in your profit loss statement, you sold right there and you closed out your position. Hypothetically, closed out your position. So you gotta go in and you gotta get the prices from which you bought it, sold it, right? Sold it, bought it, sold it. You gotta put the prices in. The technical analyst has to go through and basically identify all that stuff, for the 25 stocks, going back 3 years, using the 10, 30, and 50-day moving average system. Then what you're going to do is you're going to go into this worksheet here. You're going to put in your stocks, put in the stock names. What I would do, I wouldn't use the active portfolio, number of shares on the active. You can come up with a target pretty quickly. I can walk you through that. Or what I would do is I would just do the passive. Put in the number of shares from your passive portfolio and stick them in. Okay? So those are going to be the number of shares that you're going to be trading over the 3-year period. Then you're going to stick in, what you bought it for based on the buy signal, and then what you sold it for. And you're going to keep doing it based on the number of trades over the 3-year periods for the individual stocks. Then what you're going to do, once you put in all of that data, you're going to go down here and you're going to look at how much money you made trading the individual stocks based on the number of shares, based on the changing prices. Here's your total profit loss that you made. This was the average over the 3-year period. This is how much you made in year 1, year 2, year 3. So on the $1 million that you got to invest in this portfolio, you made $222,000 over a 3-year period. That's not bad. Great. You made $52,000 in your first year, $94,000 in your second year, which is almost double, and then you made $95,000 in year 3. This is a great system. It's not a trading system where you're trading, you're not a daily trader on this stuff. You're just looking for momentum trading opportunities, that may or may come up, maybe 1 time, 3 times, 5 times, 6 times over a 3-year period. You really don't care. That's all you're looking for, is to make sure that you make money on the trade. You're not going to lose money on this system. You're not going to be doing a lot of trading. You're not going to kill it. It's not going to give you a 40% rate of return, but you're going to be able to get, on another, on the first $1 million that you put in your active and your passive portfolios, you should be getting at least 8 to 10% rate of return. You trade this, you're going to get like another 8 to 10 rate of return on your another $1 million portfolio just from trading. So you can yield enhance your passive portfolio or your active portfolio strategies by implementing a trading strategy based on the shares that you already have in your portfolio. And then what I don't have here, which I wish I did have here, was when I bought these things, I was buying call options where I was buying on margin. And when I was selling, I was basically selling short where I was buying the puts or writing the calls. If I could create a model to be able to go long short and apply the derivatives, then I'm probably getting, you know, the 40, 50%, maybe 60% rate of return on the portfolio if I can implement the derivative trades correctly based off of the trading system. I haven't tested that or developed that yet. I feel good about the methodology in designing the passive portfolios, the active portfolios. I feel comfortable with the hybrid target. I feel good at, and then this trading system is pretty bulletproof. Okay, and once you get comfortable, you probably want to implement this strategy inside your self-directed IRA. Okay, because as you're trading and liquidating these positions, you're not incurring any capital gains tax. Okay, so if I buy low and sell high, you know, I'm going to have to pay capital gains tax. If I use my self-directed IRA money to implement this strategy, there's no taxation until I pull the money out at 59.5. So I could, you know, generate another, you know, 1,000 basis points of alpha trading this on top of my passive and my active strategies. It's a money machine, is what it is. Okay, but you got to stick to the rules. Okay, you got to be dispassionate about it. If the rules say you need to sell, you sell. If it says to buy, you buy. You don't double think it. And I actually think you guys could probably program this stuff and use AI or machine learning to actually do it, automate it, and crank up a money machine, become a multi-billionaire. Okay. The other thing, that was the technical side, all right? So the fundamental side, who's the fundamentalists? Who's the fundamental analysts? Okay. So you guys, this is the fundamental worksheet. I wasn't able to do this last semester, but I want you guys to do it this semester. You have to think about the 25 stocks that you have, okay? And you got to think about the discount rates, and you got to think about the multiples, okay? Because different stocks have different expected returns, and different stocks have different multiples. So when I first built this, I built it where we were using the same expected returns in a range of multiples for all of the stocks. Okay, but I think the model is more dynamic and more valuable if you're adjusting the multiples that are appropriate for the stock that you're valuing, and you're also adjusting the expected returns. Okay, the discount rate sensitivities. It becomes a little bit more appropriate. Okay, so the first sheet, this is just a master summary sheet. The next one are the stock inputs. Here are your stocks. You don't want to be messing with this stuff. This is just basically a dashboard of the final stock valuations, all, you know, aggregated together so you can take a look at them really quickly. All the way through to the 25th stock. The action really happens in here. So this is Apple right here. So this, you don't want to touch this. This is all programmed, okay? So what you're doing, the only thing you have to manipulate is the yellow, okay? So, and here are the four evaluation methodologies, okay? So basically, for the people who took my 123 course, this is basically the programmed. It's the same stuff that we did, but now we have it programmed. I probably should introduce it in 123, but I think it'd be over everybody's head, okay? So I can do it here. So here's the inputs. So we're going to want to use 2018 earnings per share, right? Because that's last year, right? And we're in 2019, and we want to estimate 2019. Okay, earnings per share is our first year in the valuation process. So if I stick in 2018 earnings per share, and I stick in a 5% growth rate. And this is going to be 2018 and 19, so we're going to have to update these things. But if I think that this is 18, this is 19, and I think Apple's earnings per share is going to grow at 5%, I'm going to be able to get the 2019 earnings per share. Okay. So if I take, here are my discount factors right here. So my expected returns are 10%, 9%, and 8%. So but what you can do is you can change the discount rates if you want to. If the stock is risky, I'm gonna expect a higher rate of return because I'm gonna be compensated as early as possible due to the risk associated with it. So that's very simple, is adjusting the expected returns. This will flow into here. I double check the links here. If there's no links, I would link them. And then you might have higher earnings growth expectations depending on what the stock is. I mean, Apple's what? What's the market cap on Apple? What's the market cap?
It's over $1 trillion right now.
Yeah, so it's like $1 trillion. So are large companies, which ones are gonna be able to grow their earnings faster? Large companies or smaller companies? Large companies are gonna be able to grow their earnings. They're gonna be able to generate more earnings compared to the smaller companies. But it's really hard for very large companies to grow their earnings at a very rapid rate. So the mid-cap and the small-cap companies, you're probably gonna have to adjust these perpetuity growth rates. But the larger companies, you're gonna tone them down. So the smaller companies, these may be higher, these may be higher. For the larger companies, these are gonna be lower, these are gonna be lower. With the multiples, you're gonna have to look at the multiple of the company, okay? And maybe look at the peer group. But some of the multiples for some of these companies, particularly the mid-cap and small caps, are gonna be higher than this. So you're gonna be using the appropriate multiples on their, and actually you might not even be able to use earnings. You might have to use EBITDA per share and EBITDA multiples. So, if you want, you can use the standardized methodology just from a theoretical standpoint, but if you want to, you fundamentalists want to get in and really kind of customize the valuation, you're going to have to rethink these perpetuity growth rates and the expected returns and the multiples and the growth rates over the holding period for each individual stock. That might be too long for you guys, maybe too complex for you guys. So if you want to use just standardized metrics, put in the standardized metrics and just let it be. If you want to customize it and think a little bit more about these companies, then go ahead and adjust the discount rates, the multiples, and the returns. To get to probably, what'll happen is you'll be more accurate in your valuations. Because the problem that we ran into was that a lot of the students were, what did they do? They were calculating their premium discounts. I think this was it right here. So they ran the valuations, brought over the metrics for the company, calculated the valuations. These are all to be plugged, all hard-coded to the worksheet, so it flows in. You got the intrinsic values, you got the current stock price, they calculated the premium and the discount, and then sorted from high to low. But some of the intrinsic values were below the current stock price because they were using too low multiples. Okay? Or their growth rate assumptions over the holding period and the discounted cash flow were too low. To get to this page right here, a lot of students didn't even know how to sort on premium discounts. Okay? They kind of slapped this piece together. Okay? This is your fundamental securities analysis. So you got your passive portfolio strategy with the allocations. You got your active portfolio strategies with the allocations. The active portfolio strategy is going to overweight in your portfolio those stocks that are going to provide the highest rate of return at the given level of risk. So by looking at the two, passive and active, you come up with some kind of hybrid target allocation between the two. We just worked through that. So now you're done playing with the portfolio stuff. Now what you do is you go into the fundamental securities analysis worksheet, you run the valuations, you get the data in here, sort from premium to discount, and these up here are the companies you want to overweight a little bit more in your target portfolio allocation. And these down here, you're going to want to underweight in your target portfolio allocation based on the fundamental securities analysis. Now what you've done is the validation verification. You've run through the two portfolio strategies, you've come up with the target, you've used fundamental securities analysis, overweight, underweight the individual stocks within the target portfolio. Boom, once you got that set, you've already got the back test and the forward test done. Now you do the presentation, you put that information into a report, you bind it all up with the appendices, that becomes your portfolio trading strategy, okay, the book. To do this stuff, the only place I've ever seen it done is at Golden Gate University in the grad school, where you go through all the portfolio stuff, you do the technical analysis, you do the fundamental analysis, you come up with the trading system, you come up with the portfolio trading system book, and that becomes the portfolio trading system that you are going to run within your shop, depending on the platform that you're going to be on. You can do it yourself on your own platform, or you basically go and you run these types of things at other companies, either in the hedge fund environment, family office, you know, trading, commercial bank, investment bank. You can individually, however you want to do it, but that's the approach. That's how you do it. Okay. Any questions on this, on the technical stuff? Any questions on the fundamental stuff? You should be working with me if you have any problems, particularly on the fundamentals stuff. Okay, so go get the earnings. Start projecting earnings per share growth rates. Figure out the expected returns, find the multiples. Or just use the standard template right there and put in the earnings per share and the multiples to start calculating the intrinsic values for your 25 stocks. And your portfolio managers should be delegating to the analysts what to do. Okay, did it work? Okay, awesome.